Welcome back, guys. This is Cruz from New Age Wall Street, and today we're talking about implied volatility when you're trading options. So it's very important and it affects the way that the option premiums are priced. We're going to talk a little bit about that, and we're also going to stick around to the end. We'll also talk about how I use volatility to trade option contracts as well. So let's get to it. Welcome back, guys. We're talking about implied volatility today, and we're going to jump right in here. You have my screen. And basically, what implied volatility is a forecast of what the underlying ticker move may make. So the higher implied volatility as a number, the bigger estimate that the actual underlying ticker will make. The smaller the ticker, or excuse me, the smaller the implied volatility, the smaller forecasted move that the underlying ticker may make. So, for example, if we go ahead and we pull up our option chain here, um, this is looking at this week's expiration. Over here on Thinkorswim off to the right, you have the implied volatility. So it's pretty high right now at 15.88. So really, really big. So just to go ahead, just to give you an example of something to compare to. So today Tesla made a $20 move. That's why the implied volatility is rather big on Tesla right now. Now, if we take a look at a ticker like AMD, right? So AMD had a range. If we look at the chart, and I put it right here real quick, AMD had a range of 41.69 to 42.90. So about a dollar, a little over a dollar, almost $2 on it, as compared to where Tesla had a move of $20, right? So if we come back over here to our option chain, that's why you see here on AMD, the implied volatility is only 1.488, and then you come over to Tesla, where the forecast of move on the ticker is bigger, so they have a bigger implied volatility. Now, implied volatility does not give direction, so it doesn't say it's going to go up or down. You can't use it to predict direction or anything like that. Just the size of the move that may come. So it keeps the market makers safer and the way that they price the premiums. So then, if you get a big move, they're not eating up that big move. Now, and that's just to go ahead and show for our example, right? AMD versus Tesla here. Look at these premium prices. So the implied volatility affects the premium prices. The higher the implied volatility, the higher the premium prices. And conversely, the lower the implied volatility, the lower the premium prices. So if you look at these, premium prices here, you can see that these are pretty, expensive for Tesla, right? $6 right at the money, right? If you come over at, for our example on AMD, it has a lower implied volatility, so these premiums are a lot less expensive. Look over on the call side, we're looking at 60 cents per contract, 62 cents, 75 cents on the put side. So you can see how implied volatility directly affects the pricing of the premiums. Now, so that's pretty much it as far as implied volatility, and that's how it. Like I said, it doesn't affect, or excuse me, implied volatility does not forecast direction. It forecasts the size of the move that may come on the underlying ticker. So you could go ahead and factor it into your trading just as a nice to know. Well, now, a cool thing that I like to see as far as when I use the implied volatility, and something you may notice, is that directly correlated with earnings season. So with earnings season, usually we have a huge move up or a huge drop down. These crazy gaps and things, and you could tell that investors are setting themselves up for this big move for earnings, whether it's hedging, they're keeping themselves safe, or whatever it may be. And but we know that there's going to be probably a big move, because of the earnings report. So whenever for the week, right? So the week of earnings for whichever ticker you're looking at, up until the date that they actually announce, you could see that the premiums are generally higher. The implied volatility up until the date that they announce earnings is generally higher, and the premiums are a lot more expensive. So one that's notorious for this is Amazon. Amazon is already expensive. It's an expensive ticker. It has a big ATR range. So the week before the week of earnings, you get this huge implied volatility spike because we're expecting a big move on the actual ticker when the earnings report comes out. Now, after the earnings come out, though, usually the premium does go ahead and start coming back down, and it also kind of depends on when, what day of the week they announce as compared to the expiration date. So, pretty cool stuff to know. Just like I said, nice to know stuff as well when you're trading options. And one thing I do want to go over real quick also in this video is selling your contracts. So when you're trading your contracts and you're selling your contracts, you always want to make sure that you are selling on the volatility spikes. So you want to sell into strength, right? So you want to sell into when there's a lot of trading and a lot of volume that's being traded, or else this is what's going to happen. So you can see here in the screen, right? So right here on the left, this is Tesla, the underlying ticker, right? So this is the actual equity. Right here on the right, I have Tesla 375 calls that were being traded today. If you look from about right here or so to the left, this almost looks exactly right. You could tell that this is following along with Tesla, right, on the left hand side. So you can see all this volume that's right here that's being traded in this area. I mean, at one point, 700 contracts, absolutely nuts, right? So if you want to get in and out of this, the chances are of you getting in and out at the price that you want is very good. It's very good that you're going to get in and out where all this volume and all the strength is. So, but if you keep on holding, right? So if you get greedy, you start holding, and you can't even tell the pattern in this area. Look at all this volume. Where's all the volume right here? You can't even tell the pattern of the way that it was being traded. So if you don't sell into this strength where there's this volatility spikes and volume, you're going to be left holding those contracts, and you're not going to be able to get out at a decent price that you want to, and you're going to get that slippage and wind up holding the bag, so to speak, and not going to get a fill that that you actually like. So really important, guys, when you're trading options, make sure that you're selling into strength. If you're longing calls and puts, make sure that you're selling into the strength so that you could actually get filled on the prices that you want, and or even set them up a little bit, limits a little bit ahead of time, so when it does get to that area, you're the one that gets filled first. Because like I said, you want to sell where all this volume is, and it's easy for you to get in and out, instead of you're here hoping that someone actually takes the other end of your trade, so you could get out at a decent price. And that's a horrible feeling when you're stuck in an options contract trade and you can't get out because there's not enough volatility and there's not enough volume for you to get out. Cool. So that's it today, guys. Just a quick video on volatility and implied volatility, selling into strength on trading options. So that is it, guys. Make sure you like and subscribe. So let me know what kind of content you want to see. I'll keep on making videos, putting them out, and make sure that you do also comment and subscribe. All right. Check you guys in the next video. Make sure you stay money, guys.